Welcome, welcome, welcome to Anderson Reports Podcast, the audio visual experience that supports the single and indisputably best finance and investing class in all of Colorado, Anderson Reports. Anderson Reports is at the MBA program at Regis University's College of Business and Computing. Professor Kurt's students create an equity analyst report on one of Colorado's approximately 100 publicly traded companies. Check them out. In this inaugural episode, I, Kurt, interview John Rotonti of Motley Fool. Enjoy.
What's up, dude?
How are you doing, man? It's good to see you.
It's good to see you too. Doing well, thank you. It's pretty here today, so that's always nice.
Yeah. It's did you hear my story that I left here and there's an inch or two of old snow, an inch of new snow falling on top of it. Couldn't even drive on 70 to get to the airport. And it's like 7 degrees. I thought my phone was broken. I thought it wasn't showing me one of the numbers. And then I get off the plane in New Orleans, it's 75 degrees. It's perfect, man. It was
Perfect.
wonderful. Yeah.
Awesome.
It was hard to get back on the plane, let me tell you.
I bet. Especially when you're traveling somewhere where the climates are so different, because you have to pack for you have to have some winter clothes for when you get back to Colorado, but then you have your New Orleans clothes. It's crazy.
Yeah, I mean, I've experienced that. I've learned the hard way. I get off the plane in Denver, and I'm like, what am I doing? Why am I wearing shorts? It's freezing.
Exactly.
I want to check my audio thing here. I run a software. I got it. I run a software audio filter because I have background noise, but it seems to do a really good job of clearing it out.
I can't hear any background noise. It sounds clear.
It just started there's a lot, but it's a cheap little thing that just kind of runs in the background. I never worry about it. And it just works. It's wonderful.
Awesome.
I don't actually know if we're going to have students. I told them, I said, look, the way I'm going to schedule this is I'm going to pin down John whenever he's available. And if you can come, great. If not, and he can't, you can see Jennifer on this call. So she's actually at work. And so she's not going to be able to participate, but she wanted to listen in. And
Awesome.
But what we can do is we can record it and they can listen in later.
Sounds great.
And we can you and I can just have a conversation about what's going on in the financial markets and what's interesting, exciting to you. I'm normally here. Let me go start the recording.
Sure.
Oh, it is recording. All right. Well, I'll do some editing, I guess. All right. So here we are with John Rotonti. I don't think my podcast even has a name yet. Maybe it's the Anderson Reports podcast.
I love that.
Yeah. And I you and I, last time we did this, I recorded you saying some wonderful things about Burkenroad because I was pitching to Regis the value of a class like this. And you had said how it, positively changed your life. And I captured those recordings. I tried to send it to Peter Rischuti so he could feel some appreciation for the work he's put in his life. And I made like a 30-second clip of you saying, yeah, it's the best thing ever. I don't know if you ever saw it.
I don't know if you saw it either. It was the best thing ever for me. I think these types of classes that teach, business research, business analysis, and valuation are important for people that want to go into the investing world, as well as people that don't want to go into the investing world, because hopefully we're all investors in some way, trying to save for retirement or whatever reason we want to invest for. Investing is just foregoing consumption today so that we can consume more down the road. And that could be for retirement or to leave to our heirs or to, pay for our kids' university education one day, buy a second house, whatever your motivation. Investing is important, I think, and people are living longer. And so there's a question of whether Social Security, will be enough to sustain people in their retirement ages as we live longer. And so, yeah, I think classes like Burkenroad and yours, Kurt, are important for all people because hopefully on some level we're all investors.
Yeah, Regis, I have this focus where I'm bringing in guests in the investment industry. I came from the investment industry myself, and the whole, the conclusion of the class is to have that recommendation buy or sell, and it really fits into the investment world. And I found myself, one of my learnings this year has been helping the students to refocus on the purpose of the writing. The end goal is to educate the end reader is a potential investor, and it's been really helpful and it's wonderful. Now Regis will say that their focus is to create future CFOs for small companies.
Yep.
And so we've had to translate the skills that we're learning, the financial modeling, the accounting mastery, the strategic analysis. But it's that piece of the communication piece. It's the writing and the putting yourself in the shoes of your audience and knowing what they want and what's, really doing the with them, the what's in it for me,
Yeah.
for their side. I think so. There's, I have a list of about 9 skills that this class ends up, requiring, and they are all translatable to pretty much, because they're early on in their careers, so it's almost anything that's happening in their in any finance job. There's going to be something that touches on this.
Totally. So 2 things that come to mind there are, I remember when we were going through our MBA together, you and I, you were doing a lot of public speaking training and public speaking classes at the time. I remember this was 2009, maybe. You introduced me to TED Talk for the first time. I had never heard of a TED Talk because I spent a lot of my time just reading books or white papers or newspapers, news magazines, whatever it was. I spent very little time then on YouTube or other media like that. And you introduced me to TED Talks. And so you were part of Toastmasters. And so we're going through MBA, and I remember you also, spending hours a week or whatever it was doing Toastmaster classes and presentations and stuff. So you always prioritized public speaking. The other thing that comes to mind is I once heard a famous hedge fund manager at a conference say, so someone in the audience asked him, what do you look for when you hire new analysts? And he said, obviously we want, people passionate about business investing, doing thorough, rigorous due diligence and all of those things. But we also look for communication skills, both written and verbal, because it is so important in this industry. So yeah, 100%, Kurt.
Yeah. Let's pivot to either the company we're covering, your checklist, or the financial markets. Those are kind of the 3 next items on the agenda, I think. I'm kind of most curious about your opinions on the financial markets. I used to follow the Fed more closely than I do now. And I've seen you tweet recently, that no, we've forgotten how to think about inflation, right?
Maybe. I don't know if we have forgotten how to think about it. I just think that we've forgotten that it's a thing, because so there's this common phrase, which is we've been in a 40-year bull market in bonds, and all that means is that interest rates have been falling for 40 years. It's actually pretty surreal to look at a chart of interest rates over the past 40 years. And there's reasons why that may be. One is that technology is at its core deflationary in nature, by nature. And so if you think about technology, Netflix, for example, made it cheaper to consume entertainment. You don't have to drive to a movie theater. You don't have to spend the gas at the movie theater. I mean, movie tickets these days are, I don't know, $15 or $20, but Netflix is less than $20 for a month for your whole family and for the whole household, right? And so, Netflix made it cheaper to consume media. Google made it cheaper to get any type of information. You don't have to go to a library. You don't have to have a library card. You just Google it for free. Facebook made it cheaper to communicate with people. You don't need a phone. Amazon made it cheaper to shop. Amazon made it cheaper to start a business because now you can, rather than having to spend tens of millions of dollars building out physical compute infrastructure, you can just rent compute space from Amazon Web Services or Microsoft Azure or whatever it is. And so technology is by its nature deflationary. And so, yeah, I think what I tweeted was that for the last 40 years, interest rates have been falling. For the last 30 years, inflation has been benign. And for most of the years since 2009, money has been basically free. And so we know that people and investors, but really all people, suffer from recency bias. And 40 years is a long period of time. And so I just don't know if the markets have fully priced in inflation for longer. If that turns out to be the scenario that plays out, I don't know. I'm not calling that. I don't know if it will turn out that way. But if it does turn out that way, I don't think the markets are fully pricing it in. Inflation is it makes business difficult. It makes business difficult. Some businesses are hurt more than others. But yeah, so I don't think it's fully priced in yet. I think that some stocks have not all of them, have a bumpy road ahead of them. Some stocks have probably fallen further to fall. And regarding the Fed, this is a timely discussion that you and I are having, because this is Fed rate hike week. This is the week that the Federal Reserve is going to begin hiking the federal funds rate. Since the pandemic, the federal funds rate has been zero. Technically, it's 0 to 0.25%, but it's called ZIRP, zero interest rate policy. But let's just call it what it is. Money has been free since the pandemic, and this is the week that the Fed is going to start raising rates. So these are interesting times. The Fed is trying to raise interest rates in other ways as well. It has two other tools at its disposal. So one is the federal funds rate. They set the federal funds rate, and all other rates sort of feed off of that. The Fed has two other tools at its disposal, two other primary tools that it has communicated it intends to use. The first is it's going to stop buying $120 billion of securities every single month. So up until basically this week, it has been buying $80 billion worth of US Treasury bonds and $40 billion worth of MBS, mortgage-backed securities, every single month for $120 billion. And when you buy bonds, which is what it's doing, $120 billion every single month, when you buy bonds, the price of the bond goes up, but the interest rate goes down. As you know, they have an inverse relationship between price and yield. And so that's the second way it's going to start raising rates. It's going to stop buying $120 billion worth of securities every month. And then the third way is, because it's been buying $120 billion of securities every single month, it has built up this mammoth, gargantuan $9 trillion balance sheet. It's almost crazy to think about, but it's $9 trillion. And they're going to start shrinking the balance sheet at some point, either by just not renewing those bonds when they expire, not rolling them over when they expire, or by actually selling bonds off their balance sheet. So they have three tools, and all of them have the intent to raise interest rates.
So one is the Fed funds rate, and the other one is that the FOMC?
So the FOMC is the open market committee the meeting basically where they determine what they're going to do with the Fed funds rate. But the other two are to stop QE, stop quantitative easing, which is this buying of $120 billion worth of securities every month. That's the second one. And then the third one is to shrink the balance sheet.
So QE and shrinking the balance sheet are like intimate or related, right? Because the balance sheet is that purchasing, right?
Yeah, they're related. QE is to stop buying, and then shrinking the balance sheet would ultimately take the form of not rolling them over or selling. I don't think I don't think they intend to sell bonds just yet. I think that's part of the plan down the road. That would actually be that would be QT. That's the opposite of QE. QE is buying bonds, quantitative easing. QT is the opposite, quantitative tightening. But the point, Kurt, is that during the pandemic, which was it was a shock to the system like we haven't seen in a really long time, because one, it was a global pandemic that was killing thousands of people a day, and it's ultimately killed, I think, 6 million people around the world, which is just deadly. But also it was a shock to the system because overnight, basically, it changed the way that people work. At least it changed the way that office knowledge-based workers work. And we started working from home virtually overnight. And that was a tectonic shift. And so as part of that, governments around the world also issued shelter-in-place orders, right? And so governments around the world shut down their economies. We had a global economic lockdown put in place. This is a once in 100-year event, this type of global economic lockdown, where you're telling people you can't go to these restaurants, you can't go to these stores, unless they were stores that were deemed essential, right? It was the commerce, brick and mortar commerce at least, was locked down. And so the government response was twofold. Monetary policy from the Federal Reserve was to set rates at zero and start buying back a ton of securities to spur demand. And fiscal policy from the government was to hand out checks to people, government transfer payments. And so if we look at monetary, quantitative infinity, basically, quantitative easing to infinity, and then fiscal policy to infinity, we got this bazooka of liquidity shot into the markets like the world has never seen, Kurt. There was no precedent for this much liquidity being shot into the markets. And if you look at how stocks perform over time relative to liquidity, it's almost a mirror image. Stocks perform well when liquidity is ample, and then stocks perform less well when liquidity is being pulled from the market. And right now we're about to enter a Fed tightening cycle, and liquidity is about to be pulled from the markets. I don't know what that means. I don't know if the historical trend holds or not, but yeah.
Isn't it? I heard a quote, well, and I'll frame it by saying, I think it was Peter Ricciuti who had said that the yield curve has predicted 13 of the last 9 recessions or something like it. It's a funny way to say it, because the yield curve will sometimes be wrong. But my question was about doesn't the Fed tightening, hasn't that triggered most of our recessions in the past?
I don't know if it's most. I do think that recessions in the past, I think that's one of the reasons. I think it's one of the reasons recessions have been triggered in the past is the Fed tightening cycle. I think others are commodity shock for sure. Oil price shocks to the upside have also been associated with recessions in the past.
And we're in that now also, right?
We're in that now. Oil has been, it's down from $130 a barrel to about 100 now, but yes, we're in that now. Look, the Federal Reserve So inflation is running really hot. It's 8%. Inflation just came in at 7.9%. So it's 8%. Let's just take even one step further back. The Federal Reserve has two mandates. It has a dual mandate. One is to maximize employment, and the other is to keep prices normal. Yeah, stabilize prices. Employment is very strong right now. We have a 4% or so unemployment rate. Employment is extremely, extremely strong. So, they get a check for that. Right now, they've covered that mandate very well. They are behind the curve. And this is not my opinion. This is a fact. They're behind the curve when it comes to inflation. And they're far behind the curve when it comes to inflation. And so they need to act, and they know they need to act, and they have communicated that they need to act to bring inflation back down to its to their long-term target of 2%. To do that, they need to, we need to take a step back even further. Everyone sort of associates inflation with rising prices, which it is, but what underlies the rising prices? It's a supply-demand imbalance. That is what ultimately causes inflation. That's microecon 101. And right now, demand is extremely strong, and there's reasons we can get into if you wish, and supply is extremely tight. For those reasons, prices are rising at an uncontrollable pace right now. 8% is worrisome. 8% is worrisome inflation. And so what the Fed needs to do, going back to that supply-demand imbalance, is decrease demand. That they're actually trying to slow down the economy. There's no secret there either. The question, and to your point about Fed tightening cycles sometimes tip us over into a recession. The question, Kurt, is, can they slow down the economy without tipping us into a recession? I'm hopeful that they can, but the risk is that we have a policy error from the Fed, and we do tip over into a recession. That's what you hear when you talk about, can the Fed navigate us into a soft landing? That's what they're talking about. Can the Fed slow down the economy, but slow it down just enough without tipping us into a recession? And so that's sort of threading the needle, if you will. It's going to be tough. I'm hopeful they can do it, though.
Yeah, a couple of things are showing up for me there. I like to talk big and get weird with conversations sometimes, and so here's my thought. I have some friends who would call themselves Austrian economists, and they advocate for just as a separation of church and state was a good thing for humanity, the separation from the economy and state might be a really good thing for humanity. This comes from the belief that the government is bad at just about everything it tries to do, you and I are talking about this business cycle with the ups and downs, or the recession and boom and bust and bubbles. And I'm going to pivot this into our crypto conversation, because we have this Fed and these economic powers. They're non-political, they're unaccountable. They're trying to do the best they can. It was a while ago that I was given an update on the economy, and before the before the pandemic. And I was exploring the idea of I actually didn't know I was doing it, but I was into the idea of the modern monetary theory, where money in the system is a capacity metric. And so you should have as much liquidity in the system as possible, because that's the ability of people to do things, is that liquidity, is having money like that. But what I learned then was that the Fed they put that money out there, is what we've called the quantitative easing. They can suck it back up when they need to because of inflation. And I thought, my hypothesis back then, which has been proven wrong, which was that is they can manage this. They can put enough money out there, and then inflation will never be a problem again. 40 years without inflation, I thought inflation will never be a problem, but I thought it was because the power, the rulers above us can suck up the the capacity quick enough. And it almost, I don't know, maybe they're not acting quick enough. I'm afraid of, do they have a, so there's two questions here. One is, does one or the other pieces of the quantitative easing, whether it's the Fed funds rate or it's the quantitative easing, for some reason, I just feel like the quantitative easing feels like they're manipulating the market. I also had the idea in my mind that they were buying AAA rated bonds, commercial bonds, corporate bonds. And didn't Japan even get so far as to, they were buying equities? That's how aggressive their quantitative easing was. But so the first question is, do you have an opinion on the two different tools that we've described that the Fed has between quantitative easing versus the Fed funds rate, and what they should do next? And then we're going to talk about, is the Fed, is this a net positive, right? Like what would happen if we just had hard money? And I mean, is this an idea that's gone away with the dodo bird in the 1970s with Nixon opening, putting the, deconnecting the US dollar to gold? And we'll talk, I'm going to ask you about crypto after this a little bit.
So I don't know what the Fed should do next. That's just above my pay grade. And I'm not a Fed economist. As far as the two big tools they have, the raising the federal fund rate and then the balance sheet side of it. Chairman Powell himself, in his February notes, in his February meeting, said that there's much more uncertainty around what they're going to try to do with the balance sheet, because they have data, they have examples, they have past examples of how markets and economies have responded to an increase in interest rates. We've never tried to shrink a balance sheet of this size before. So that's unprecedented. That's the wild card here. And even Federal Chairman Jerome Powell, Federal Chair Jerome Powell said himself, they really don't know how that is going to play out. They just really don't. There's much more uncertainty around the balance sheet than around raising the federal funds rate. And so if I had to guess, and this is a wild guess, of which one sort of presents a bigger challenge to the stock market or to our economy, it's going to be the balance sheet, just because it's unprecedented. We don't know how that's going to play out. And 9 trillion is such, I mean, how big is our economy? 26 billion. That's just so, yeah, I'm sorry, trillion. Yeah, 26 trillion GDP. So that's crazy that we have a $9 trillion balance sheet, just crazy. So that's the one that concerns me the most, but maybe it's an unwarranted concern. What was your second question? I'm sorry.
Well, so it got into the nature of fiat. My students are, I'll just build some more context around it and tell you a little bit of the story of the company we're covering right now, or trying to get our claws into a grip on the industry analysis piece of the report for Riot blockchain. So the industry analysis is the crypto mining industry, which is, completely new and fun and strange and weird. And so Riot blockchain, they only mine Bitcoin. Now they've started to diversify their revenue by leasing out space for other miners to use their technology or their space or their machines and really their advantage has been, low cost access to mining. They do that through acquiring the best machines at the cheapest price, but mostly through strategic locations. It's important for a crypto miner to be either in a cold location where, because these machines run hot, or these guys have America's largest crypto mining facility, and it's in Texas because it's next to these wind farms and the renewable energy in Texas and the deregulated market where they've negotiated these deals with the energy companies and they pre-buy the energy at a certain price. And if it goes the other direction, they can sell it back for cash and they make money doing that. They also, just a side note on that story is they'll say, because we're big buyers of energy, new technology, new power plants can go, and green ones can go online with their financing. So they've got a forest behind them that's going to become a solar plant that'll be there. It'll be there forever, or it strengthens the grid is their argument. But my students, I'm asking them to kind of explain crypto to our readers, and it's hard to explain. The supply side, at least for Bitcoin, is fixed, and it's simple enough that because the amount of Bitcoin that's released every month is practically, for all practical purposes, a fixed amount. So supply is boom, there you go. There's a straight line. It's easy. The demand side is really weird. It's like I can't wrap my head around why people want to hold crypto, and the company is telling us, and I don't think they're wrong. I mean, it's already been it's been past, as we would say in New Orleans. It's done did the legitimization of crypto. They still want a little bit more regulation. They certainly want it to be taxed because the government will love it. The government will love it if the government's taking money from it, right? So they want it to be taxed. They want it to be regulated so that it's legitimized. But and they say that they're at the beginning of the year, or last year, beginning of 2021, there were 3 publicly traded crypto mining companies, and I think they were all in Canada, or 2 of them were in Canada. Now there's 20 of them. So in 1 year, this market has, he used a phrase that every year in crypto is like a dog year. Like it's like 7 years of progress, and their financials, as we're looking at it, kind of reflect that. But the supply case of crypto is fixed, at least for Bitcoin it is. And then the demand case is fascinating. He's saying, well, Morgan Stanley and the wirehouses and the asset managers, crypto is going to be, it's a asset class that people want in a diversified portfolio. So we're looking at the correlations to, the topic of the day is inflation. We got to, and it's not really doing what it was supposed to there. I think I'm going to have to check those numbers. And it's supposed to be, uncorrelated to other assets, and what a great diversifier that'll be. And also there's this weird thing that I've discovered called NGU, which is number go up, that somehow this thing has been designed to game the human greed. And so people are buying it, but it just feels like a bubble to me because there's no cash flow from it. There's no, I just don't understand the fundamental argument of holding cryptocurrency. But there is this dream, and this is what triggered me. The Bitcoin dream is decentralized decentralized money, and the hardest money possible. The argument is that hard money always beats soft money. And when you have what you and I are talking about is a fiat currency where the central bank is making moves, and it's moving the amount of money in the system, which is, I think you can correct me here, most directly connected to inflation, is how much money's in the system.
It's the amount and the velocity of the money. But yes.
And velocity is how many people are using, how many, like when you give, if I give $1 to my hairdresser, then my hairdresser can go give $1 to that same dollar goes to my hairdresser's mechanic to fix the car. And then the mechanic can use that same hairdryer that same dollar to go to the grocery store. And that's kind of what you mean by velocity of money.
Yeah. So it's exactly right. How often money moves within the economy. And the best example I can give is, a lot of money was also pumped into the US economy after the global financial crisis, the GFC in 2008, 2009, not nearly as much as we saw with COVID, but a lot.
It was unprecedented then.
It was unprecedented at the time. Exactly right. And everyone said, oh, these hundreds of billions of dollars that are being pumped into the US economy, it's going to cause inflation. The reason it didn't at the time was because the banks did not lend it out. And so the Fed did pump, and the government, so monetary and fiscal policy, did pump a ton of liquidity into the market, but then it sat on bank balance sheets because the banks were reluctant to then loan it out. And so it was not exchanged from one entity within the economy to the other. It just kind of sat on bank balance sheets. That's one of the big reasons we did not have inflation after the GFC, after the global financial crisis. The other one we talked about earlier was technology is growing at a very fast pace right now, and technology is deflationary. So yeah, before I hit your point on crypto really quick, I think I looked it up. So US GDP is 24 trillion. We were close. Right. 9 trillion of that would be, 38% basically. So the Fed's balance sheet is 38% of our entire US economy at 24 trillion. Do I think that Bitcoin should be part of a balanced asset allocation? Sure. I think it all comes down to, so I'll break that down further, but I think it all comes down to position sizing, right? So I don't think it should be, well, I'll just speak for myself. I wouldn't make it a 20% position in my portfolio, but that's based on my risk tolerance. I don't give financial advice on how people should allocate their portfolios, but I don't think there's anything wrong with making Bitcoin a small percentage of your net worth and thinking about it like that. Whether you think it's a hedge against inflation, the hedge against inflation argument isn't holding any water right now, because we're seeing inflation for the first time and Bitcoin's down 40% from its high, right? And so, because I don't follow Bitcoin, like literally I don't follow, but I think it hit 65,000 and now we're around 40,000. And so, Bitcoin's down 40%. You would think it would hold up really well in an inflationary environment if it was a hedge against inflation. But whether you think it's a hedge against inflation, whether you think it's a hedge against chaos, right? Whether you think it's digital gold, which is probably, I think digital gold is the function that resonates most with me about Bitcoin. Yeah, if you want to, if it's me, I have not done this yet. I've sort of backdoored my way into an investment in Bitcoin through some stocks that I hold, but I don't have any direct investments in Bitcoin. But I could see myself making it 1 to 2% of my net worth at some point in time. So as long as I'm thinking about it based on a diversified portfolio of assets, and it's for me, based on my risk tolerance, a small position, I have no problem with it. It's just, I call it a spec bet. It's a speculative bet on the future. Honestly, that's how I look at it. I'm not saying it's speculative. I'm not saying it's a gamble, but based on what I know about it at this point in time, and based on how you can't intrinsically value Bitcoin, right? Because it doesn't throw off any cash. So we can value a business because businesses have the potential, at least, to generate cash. We can value a piece of real estate, an apartment building, because they throw off cash. We can value land or farmland because you harvest the crops, you sell them at market, you generate cash. Those are cash generating businesses. And so we can estimate their intrinsic value or their business, their underlying value. There are other asset classes that can be great investments, but in my opinion, they're speculative simply because you can't estimate their fair value. So this is, baseball cards, wine, art, antiques, diamonds, gemstones, precious metals, cryptocurrencies, NFTs and all of these things, they don't throw off cash. And so you can't estimate their intrinsic value. And so they are speculative in that way. That doesn't mean there's not room for them in a portfolio. There are a lot of great stock investors out there that focus on cash flows all day long and all night long. And yet they have these great art collections and these great wine collections and these great antique collections. You know, a lot of people have great comic book collections, whatever it is. They're investing in these things, even though they don't generate cash and they can't value them. So I see no problem making a speculative bet in Bitcoin.
So I did. So you said you don't follow that. So that triggered me to want to ask, what do you follow?
I follow free cash flow.
Yeah. Yes. And don't you also you really like return on invested capital? This seems to be your favorite metric.
Yes, but return on invested capital is one of the two primary drivers of free cash flow. Free cash flow is my guiding light. I want to see companies that are growing their free cash flow, in particularly their free cash flow per share, because dilution matters, and I'm a shareholder. Free cash flow is driven by, Kurt, it is driven by revenue growth and incremental return on invested capital, period. Those two numbers, they drive free cash flow. And so, yes, I love return on invested capital because it's a primary driver of free cash flow. That's what I follow. And I spend a lot of time doing it. I mean, I work 10 to 12 hours a day looking for companies, and probably another 5 hours on the weekend, not both days, but total on the weekend, looking for companies that I think have a long runway of free cash flow per share growth. And I want it to be a company that I think I can model within a reasonable degree of certainty, with a high degree of a reasonably high degree of conviction. And so what do I mean by that? If a company is growing 100% a year, I can't model that. I don't think anyone really can, but I know I can't. I don't have that skill set.
That's exactly what we're trying to do with this company.
Yeah. It's just, if it's growing 100% this year, what I can almost guarantee you is that it's not going to be growing 100% in 10 years.
Right.
I can almost guarantee you it's not going to be growing 100% in 5 years. What I can't tell you though, Kurt, what I cannot tell you is whether it's going to be growing 75% or 10%. And when you're talking about modeling something over a 10-year period, the difference between, 70% growth and 10% growth is a different galaxy. And so if I can't model it, I don't waste any time on it, really. Once again, if people that I respect love the company, then I have no problem taking a small speculative position in that company. I have no problem with that. On some level, I'm going to take some small gambles with my money on some level. Yes, I consider them gambles for these sort of early stage, companies early stage in their life cycle. They're growing extremely fast. They are non-earning. They are cash burning. They are not self-funding. They rely on the kindness of strangers. They rely on outside capital to grow. I don't mind taking a tiny position, but I'm telling you, it's going to be a tiny position for me. That's how I think about risk. But what do I do? What do I follow? I follow companies that are growing their top line, their revenue organically, usually in the 5 to 20% range for the most part. But let's say, on average, I'm focusing on companies growing, let's say 10 to 15% top line. Even if we can even simplify it down more, let's say I'm focusing on companies growing 10%, and there's going to be a little bit of margin improvement because they're great businesses. And, that gets you to double-digit earnings per share, free cash flow per share growth. especially if you add in some smart buybacks. And so that's what I'm focusing on. Mid-teens free cash flow growth. Ultimately, at the end of the day, all that matters, like literally, all that matters at the end of the day is free cash flow growth.
So these, I can't help but think that you're gonna be chasing after a nice shit. That's the wrong phrase. You're gonna be interested in sort of, maybe not. It's newer companies, right? Like you're not. I mean, is an old, is Microsoft gonna pass your filters, get through your checklist?
Yes, absolutely.
Okay.
It is. So I would
Because
say,
they're in technology, but
yeah, that's one big reason. I would say, once again, there's no right way. There are several ways to make money in the stock market.
there's a lot of ways to lose money. There are a lot of wrong ways.
There are those as well, but there's several ways to make money in the stock market. You just have to know what you're good at, and you have to stick to your circle of competence and your comfort zone and all of those things. My comfort zone, at least for my larger positions, were ultimately all that matter, right? I mean, like if I have a $1,000 position in some spec bet, and I have $100,000 position in one of my larger positions, right? Like I'm watching that $100,000 position. I don't care what that $1,000 position does, right? So for my larger positions, these are, for the most part, companies that are further along in their life cycle. They're not mature, they're not declining, but they're further along in their life cycle. They have, already achieved scale. They are highly profitable. They're definitely growing. I only invest in growing businesses, but they are highly profitable. They have high or rising returns on invested capital. They have excellent management teams. They're solving important problems. And they have growing free cash flow. I cannot say that enough. But yes, they've already achieved scale. And in most cases, Kurt, for my larger positions, they operate in global oligopolies, duopolies, or monopolies. I don't want any serious competition. I want companies that are a decade ahead of their competitors if I can find them. And so, yeah, I'm actually not looking at early stage startups. I'm looking at companies that have already achieved scale, yet still growing, still finding new ways to grow as well, stacking on new growth curves, but they are generating a lot of free cash flow. And I want to see that free cash flow to be growing. And then I said ultimately the only thing that matters is growing free cash flow. The other thing that matters is that you pay a reasonable price. The price that you pay matters, and investors are realizing that right now. Technology companies like glamour stocks, tech darlings, they're down anywhere from 50 to 90% right now.
Wow.
A lot of them. And that's because the market momentarily forgot that valuation matters, but it does matter.
And it does that. Like we always, you and I were taught, and you probably know it more intimately than anybody. I mean, you and I are both fundamental thinkers, fundamental analysts, and the markets will, we also, at the same time that we know that the markets can remain irrational longer than we can remain solvent, we do know that it's going to revert to, I don't know if the fundamentals is the right word there, but what you just said, that it's the phrase I'm looking for is not that common sense will prevail. It's that
sanity will prevail.
Yeah, that fundamentals matter.
Fundamentals drive stock prices over time, over the long term. In the short
long
term
is the key word there, right?
Yeah. In the short term, it's a popularity contest. It's who tells the best story and the momentum behind that story and all that stuff. But in the long term, stocks follow sales and earnings and free cash flow up over time. Stocks follow fundamentals over time. And yeah, I would agree with that.
That's very good. I don't know if we hit on everything on the agenda here. I have a guest who's in it, who's here, Rob Yu, and Rob Yu is he knows Burkenroad very well, as he started up the Burkenroad Reports. He started one up in St. Louis, Missouri, at Webster University,
Awesome.
and yeah, and now he's helping me start up Anderson Reports at Regis here in Denver, and he's doing that remotely. He lives in St. Louis, but he's the one he does a lot of good things for me. He reminds me that I'm supposed to be studying for the CFA. That's one thing, and he also reminds me that I should go to the Burkenroad conference down in New Orleans. I was a little spoiled this year because it was on Zoom and I didn't have to travel. But do you think you're coming down this year? Oh, you're there. That's right.
I'm here.
Yeah.
I
You think
just,
you have a spare bedroom for me to crash in while I go to the Burkenroad conference?
I definitely do. My sister took my bedroom during Mardi Gras, but yeah, I actually just spoke to the Burkenroad class a couple of weeks ago. So I stay in very close contact with Professor Rashidi. And in fact, we emailed each other this morning. So yeah, maybe I'll see you at the conference.
Very good. I was good. What was when you went to guest speak to the Burkenroad class? What was what was your takeaway from that, or what was it? What was your favorite part of that?
Um, I mean, Professor Rashidi just prepares that class so well, right? They're so knowledgeable, and they just asked me great questions. The topic of this year's presentation was just ESG, environmental, social, and governance investing, and it was mainly a Q&A led by Professor Rashidi, just like a fireside chat.
Mhm.
But the students also asked some great questions, and so I think that the biggest takeaway was just how prepared they were. Their questions were very thoughtful and very relevant to some of the things going on today.
Yeah, ESG was on my soft agenda for today. I think we might be running out of time, but I guess I'll ask you for your quick takeaways. But before I do that, I'll ask you if you watched Asworth Damodaran did a take on ESG that all of my beliefs about ESG are exactly from his 30-minute presentation on it, which was
Uh,
that it would be nice, wouldn't it? But price reflects a lot of things.
I love that. Price reflects a lot of things. You should tweet that out. That is so great. Price reflects a lot of things. So I didn't see the presentation, but he also published an article on his blog, and he published a white paper in a peer-reviewed journal, and I read both of those.
So you know it then.
Yeah,
He's very skeptical.
He's skeptical because he can't find data saying that it leads to sustainable outperformance. So yeah, there's look, ESG is it's such a difficult and complex topic, because you can find some ESG violation, quote unquote, at any company you look at. If you look deep enough, any company that you look at, if you look deep enough, you'll find some problem, right? And so whether it's on the environmental, the E, how they treat people, this S, or their governance, the G. And so, you have aluminum cans are actually great for the environment. Obviously, they're better than use once and dispose plastic bottles, but they also are, there you go. Yeah, Ball, based out of Colorado, based out of Broomfield, Colorado, by the way.
Yeah, my wife works there.
Okay, there you go. And they're also, they require much less energy than even glass bottles. But how do you make aluminum? A lot of aluminum is made with coal-fired generation. And so, if you go deep enough, it gets you to coal. Solar panels that go on houses, right? It's good for the environment, but a lot of them are made with very low paid labor in China. And so it's ESG is a conundrum wrapped around, a massive puzzle. And If someone can figure out a way to do it well, I do think they can outperform the market. But it's really, really, it's complicated. And I don't think that a lot of investors know how complicated it is. Yeah. But, do I want to find companies that treat people and the planet well? Absolutely. Absolutely. Do I want to find and invest in companies that there's this firm that I admire deeply, deeply called NZS Capital, and NZS stands for non-zero sum. And basically they're looking for companies that create positive NZS or positive non-zero sum, which simply means they're looking for companies that create more value for their key stakeholders than they take for themselves. And yeah, I mean, it's an incredible mental model in my opinion, if you can find companies that give more than they take. And so that's sort of like taking ESG to the next level. And that's the type of ESG investor I want to become. I want to get better at looking at things through that lens. And NZS is truly a pioneer in that space.
I'll check them out. I had gotten interested in B Corps a little bit.
Mhm.
And I went looking to see if we could run this class looking at only B Corps instead of my primary filter being Colorado-based companies. I wanted my primary filter to be B Corps. And what I learned is that as students, as researchers, we need the transparency that the public markets bring. But there are some, not many, but some B Corps that are publicly traded, and I think that's an exciting development. I hope that's, I fall victim to my human biases. I can get way too excited about the feel good
Mhm.
nature of a ESG or a B Corp, and it has to translate into US dollars to be meaningful, I think. But maybe not. Maybe there's some wiggle room in there where we can, like you're saying, like we can get a reasonable assessment on, is a company producing a net positive for humanity if we can measure it correctly.
Totally. I mean, it's really complicated, Kurt. Look at right now, right? So oil and gas drilling, right? Not good for the environment. Like, we know that. No one's really arguing that. But right now, the government, the administration is doing everything but forcing. They're begging US drillers to drill more right now because the price of oil shot up. And so when it becomes convenient, we can talk about ESG. But when the going gets tough, drill, baby, drill. And that's something I was wrong about. I thought that we would see a steady decline in demand for oil and gas, a slow but steady decline. But I did think it would be slow, but I did think it would also be steady. And I was just I could not have been more wrong. ESG will mind freak you, dude, if you let it. There's so many levers, so many different things that make it really, really difficult. And so right now, yeah, we're in this geopolitical conflict, which is awful. And one of the consequences is oil prices are shooting up at a time of already high inflation, and that's driving inflation higher. One of the things people don't understand about inflation is inflation begets inflation. That's what when you hear about the wage price spiral, it's just inflation begetting inflation. Inflation causes inflation, and then disinflation causes disinflation. And so it's a very unopportune time to have gas prices, above $4 a gallon when everything else is going up in price as well. And so the US government is begging oil and gas companies to increase their output. And it's not easy to do. It takes months to increase output. So yeah, that's something I was wrong about.
So what you're saying is you didn't predict the Russian invasion of the Ukraine.
Definitely not. But I think I would have been wrong anyway, Kurt. I don't think that oil and gas was going to steadily decline as I thought it did. I no longer think that's the case.
Well, let me ask you, do you have a hard stop at 11 o'clock, or you're good to keep talking?
I can maybe another 5 minutes.
Okay.
Yeah. But then I have to prepare for a meeting at 12:15 my time. But yeah, investing is hard in general, whether it's ESG or not ESG.
And you seem to make a distinction. I'm kind of curious where you might draw that line on your vocabulary when you say gambling, because I'll teach the students the difference between trading and investing is basically your time frame. But I also teach them that yes, it is all gambling by definition, but boy, maybe I shouldn't use that language because, and I almost want to say investing is more like horse race gambling than it is roulette, because your research can pay off. But there is a book out there, and I haven't read it, but I'm still promoting it because some fundamental analyst said it, or financial professional said it's the best book that he's read, and it's called Thinking in Bets.
Yeah, Annie Duke.
Andy Duke?
Annie Duke, yeah.
Annie Duke. Okay. Yeah. And so have you read it?
I have not, but
I'll watch her TED Talk. I don't want to read a 300-page
that's
book, but
probably a book you do want to read, though. It's definitely high on my list. It's one of the books that Michael Mauboussin, one of the thinkers I admire most on this planet is Michael Mauboussin, and he speaks extremely highly of Annie and of that book, extremely highly, Kurt. Okay. So yeah.
Maybe that's where I got it, but
Michael Mauboussin could tell me to run into a brick wall, and I'd probably do
it. John is ready to join a cult.
Yeah,
he's ready to submit his agency to.
he's a brilliant thinker and teacher.
I would do that for Peter Raschuti.
Yeah. Look, gambling for me is taking tiny positions. Okay. Tiny. I really want to stress that. It's at the long tail of my portfolio. It's tiny positions in companies that I have either not researched or don't understand or cannot value or all of the above. Yet someone that I respect or multiple people that I respect do feel as if they understand the business, do feel as if they can value the business, do feel as if they understand the underlying technology that the business is trying to sell, for example. And these are people that I respect and people that I try to learn from. And maybe I take a tiny position just because they do have a high conviction in the name. So it's not that I have a low conviction, it's that I don't have any conviction. It's that I may have not even read one word about the business. It's that if I did try to value it, it would be a complete clown show because they're unvaluable. It's those types of businesses that at least with my skill set and my knowledge base, they're unvaluable to me. Yeah, that's gambling. I do not think investing in great businesses that are growing profitably and treating all of their stakeholders well and holding them for a long time, I do not think that is gambling. I think that is investing. And those are my larger positions. My spec bets are just tiny, fun rolls of the dice. Yeah.
Let me, well, I think we can wrap up with this question. So you mentioned that you're reading, say his name again, Mauboussin?
Michael Mauboussin. He's read several books. I mean, he has written several books, as well as white papers or reports, whatever you want to call them. He works at Morgan Stanley.
And what are you reading right now?
Right now?
Mm-hmm. All right. Scale by Jeffrey West. Yeah. What's the
subtitle? The Universal Laws of Life, Growth, and Death in organisms, cities, and companies.
Okay.
And you want to know what my reading looks like, Kurt?
It looks like you're reading it. Yes. I like the dog ear. I mean, you've got everything you can do. You've got circles, you've got highlights, you've got
I've got
boxing,
circles, I've
you've
got
got
highlights, I've got boxing, I've got different colors. Black
different.
ink on this page,
Hmm.
blue ink on this page. I've got green ink somewhere in this book. I've got red ink somewhere in this book. And can you see at the top there, I write in the margins.
Right. Yeah, that's interesting too. So does that turn into writing for you, or
It can, yeah.
okay?
It definitely turns into mental modeling, stock picking. It can turn into writing for sure.
Yeah, for me, to get to mental modeling, it's got to go through writing.
There you go. Yeah, I like that.
Writing is thinking.
Yeah. I do believe that, I like that. I do believe that if you have an idea in your head, you should always try to write it down, because if you can't write it down clearly and succinctly, then maybe you don't understand it in your head as well as you think you do. It's
Right.
bringing it from your head onto paper. If you can pass that test, and if you can write crystal clear what you have in your head, and it comes out on paper just as crystal clear, then you're onto something. But if when you put it on paper, at least for me, and it comes out to be bullshit, then I realize that what I have in my head is just not clear. And I need to keep thinking about it and keep forming it.
Yeah, and that can work with speaking it out loud too.
Totally.
But that's what you just said had me thinking of the ancient philosophy of logos, which is, the word.
The word.
Well, thank you very much for your time, John. And I'm going to require my students to watch this, comb through it, and pull out all the excellent nuggets from it. And I hope to see you in April at the Burkenroad conference.
Thanks for having me, Kurt.
Yeah.
If your students have any questions, just let them email me or find me on Twitter or something like that. I'd love to talk to them, and I'll definitely see you next time you're in New Orleans.
All right. Have
Thanks,
a great
buddy.
day. Thanks. Bye.
Peace.